Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and I run the Cyclical Investors Club service. We're going to look at Monster Beverage stock today, which came in by request. If you have a stock you would like me to analyze on the channel, and it's in the S&P 500, I will put it on my list, and I will eventually get to it and make a video analysis and post it up on YouTube for free. If it's a stock that's not in the S&P 500, I post those over on Patreon, which is $5 a month. And if you join there, you get a big discount if you ever decide to join the full Cyclical Investors Club service, where I have all the spreadsheets that you see here. I have chat rooms. I have explanations of all my strategies. You can basically contact me anytime with any kind of questions. And then I write other updates. I do a lot more macro commentary, and rather than just look at the individual stocks, which is mostly what I do on this channel for now. So today we're going to look at Monster Beverage. This isn't individual investing advice. This is just how I analyze stocks. And I'm just going to kind of take you through my process here. Monster Beverage isn't too hard to analyze, I don't think, other than it's always kind of pretty expensive, basically, because it's done really well and it's a high quality business, and it has a great track record. If you go back for a lot, I don't know if this is still the case, but maybe Nvidia has overtaken it. But for the past 20 years, the stock was one of the best performing stocks in the market with 134,000% return. I didn't own it. I almost owned it. I almost bought it twice. And right before they got the Coke deal, I think it was back in like 2015, 2016. It was right. I think it might have been 2014. It was right before this big jump. And I just, it was like a 30 PE, and I just couldn't bring myself to pay that much for it. And then they cut a deal with Coke with distribution, and then that really kind of boosted things. And then there was another point I wrote on it that it was a buy, and it was right when I was developing the strategy that I'm going to talk about today. I think it was in I was in the early stages of kind of developing it, and I thought it was a buy, and then I made some changes to the way I did the analysis, which were good changes and the right changes to make. But Monster Beverage was like right on the edge of that, and so it didn't qualify anymore at that time. And so I think I might have owned it for like a month and then sold it, just because I wanted my ownership of things to match whatever I was, telling other people about. And that was maybe back in like 2019. But it's never quite gotten super cheap enough for me to buy it again. And that does play into kind of where we're at now. Overall, this has been basically a secular growth stock. We see that here during COVID, which you can expect when people aren't going to work as much and going out as much, maybe going to college, the type of people that are really drinking a lot of energy drinks. And they had a little bit of a decline in earnings here, but then they're bouncing right back. So the real question here, so they're not very cyclical. We can just look at the earnings and try to figure out what they're likely to return over time. Now, I don't know. I mean, if we would have bought, let's just go back here and see how they've done. So this is a 13% CAGR over the past, call it 8 years, which is good, but that's probably pretty similar to the S&P 500. So it hasn't exactly been a total rock star lately, even though it's done well historically. Let's take a look at my spreadsheet here. Well, let's quickly just see where we're at here. So we have a 37 PE. That's expensive, but it's always pretty expensive. My earnings growth rate, let's see what Fast Graphs is. So Fast Graphs is 1452. So you're looking at a PEG ratio of what, like close to 3, 2.5, 3. It's pretty expensive. I estimate Their earnings growth at about 13%. That's about what their actual price CAGR has been the past 8 years. It seems pretty reasonable. They did have a couple slow years, even though we have a reason for it. But we probably shouldn't expect a 39% growth rate to continue. Analysts don't expect that. Once we get 2 years out or a year and a half out, we're looking at 13, and that's about what I think long term. So I think that's pretty reasonable. That's just a reasonable estimate. I calculated it using this trend right here. So nothing too unusual there. The question just is, how much are we going to pay for it? So last time I checked, they didn't have any debt. Yeah, so that's pretty nice. No debt to worry about. In fact, it looks like they have a little cash, so I usually give a little bonus for that. So you see the price is here, and then when I take into account the cash, the price goes from 56 to 53. So I have their PE ratio at about 36, which works out to an earnings yield, which is the inverse of the PE ratio, which is 2.93%. So the way to think about this is, if I bought the stock for $100, or I bought the business for $100, it could pay me back about a little less than $3 the first year, but that would grow at 13% per year. I usually pull the first year forward, so it would pay you back $3.32, and that would grow. That $3.32 would continue growing at 13% a year. And what I do is I look out 10 years, I see how much I would collect on my $100, and I would collect about $62 additional dollars. And so I just put that in a CAGR calculator. Well, I calculated in my spreadsheet, but you start with 100, you end with 162 after 10 years, and that gives you a CAGR of about almost 5%. So the tricky part, so this is like the expected return given these metrics over 10 years if you paid the price that you're paying right now. And this is why it's kind of expensive. So if 5% is like my threshold where I would think about selling, but I would say with this stock, I wouldn't be selling it until I potentially would if it got really overvalued. But this is, the rest of the market's only like 570, 575 right now, like 5%, 5.75% in terms of their 10-year CAGR. So, I mean, Monster is expensive, but it's not that much expensive than the rest of the market. It's also not that much more expensive, it also wouldn't return that much less than cash, right? Or bonds, but it could raise prices if we get inflation. So to me, it's like, yeah, it's expensive. I wouldn't be buying it. If I already owned it, I probably wouldn't sell it unless I saw revenues really start to decline. And this is a 3-year revenue number, and it's not anywhere close to being worrisome. So yeah, if I had bought this one a while back, I would probably just hang on to it, given where everything else is, given where the market's at, given where cash is at, given that inflation is still a legitimate concern when you think about alternatives to where you might put your money, because the S&P 500 isn't that much better. So that's what I would think about if I already owned it. If I was looking to buy it, this is like the recession number, and I blended the 2008 recession and the 2020 recession together to try to kind of estimate. And it's probably not going to get this low, honestly. So I'm probably not going to be buying it. But maybe after the recession danger was over, coming out, maybe this $30 is a potential if I got lucky, So I'm probably not going to be buying it just because it's probably not going to get cheap enough. It's just not a secret anymore. Now, they do have competition. Celsius Holdings, I don't own that one yet, but I am following it closely. It's also very expensive, but they could eat into Monster Beverage's growth potentially, and there are other competitors. So I don't think there's any reason necessarily to sell it if you own it, but it's doesn't look super compelling as like a buy unless it gets a lot cheaper. I probably would say my odds are better buying Celsius if it got like, if you think a recession will affect like growth stocks more. My odds are probably better of buying it during a recession, and then maybe I have the up and comer instead of the kind of the established energy drink, the ones that are publicly traded anyway. Red Bull's not publicly traded, I don't think. So, I mean, that's how I think about it. There's not too much more to say, I don't think. It is really attractive. I mean, you think of it as like the new Coke, like the new Coke, not the new Coke from the 80s, but the new Coke from like, the 20th century. And so you know that the business model potential is there, and the international expansion's there, and the ability to raise price. I mean, all those things Monster has, that Coke has. So there's a lot of potential, but I can't bring myself to pay 13% growth. A 25 PE would probably be, you could think about it, but like 37, that's just too much for me. So that's my thoughts on Monster. If you like this analysis or found it useful or interesting, hit the subscribe button. And if you have a request, drop it in the comments section, and I will tell you what I think. Later.